Fed for triggering gold's next rally. He is best-selling author Jim Rickards, and he joins me now on the sidelines of the Gold and Silver Summit. Thank you so much for joining us, Jim.
Great to be with you, Danielle.
So, thanking the Fed for gold's breakout rally, is that your forecast as we are about to start 2018 here?
Well, yes, let me explain why.
Yeah.
So we have an FOMC meeting, a Fed Rate Policy Committee meeting on December 13th. Right now, the market expects the Fed to raise rates. Not only expects, it's a 100% expectation using Chicago Mercantile Exchange implied probabilities using Fed Fund futures. So the market expects the Fed to hike, which means that all asset classes are priced for that expectation. Gold's been down a little bit based on Fed tightening. The euro's been down, the dollar's been up, bond yields have been up, bonds themselves have been down. All these things are priced for a Fed rate hike. What if the Fed doesn't hike rates? And I'll come back to why I don't think they will. If the Fed doesn't hike rates, the expectations are here. If the reality comes in here, that's a form of ease. All of a sudden, all those trades are going to flip. So gold will rally, the euro will rally, the dollar will come down, yields will come down, bonds will rally. All the things that the markets have priced in will turn 180 degrees. That could catalyze a major rally in gold.
And you said you don't think the Fed will hike.
Correct. Now, I've been out of consensus before. Last January and February, I was saying the Fed would hike rates in March. The market was giving it a 30% probability. Then in 2 days at the end of February, the market went from 30% to 90%. So the market's been wrong before. The market's never really right or wrong. It just is what it is. It's information. But you know, the first quarter was a time when I said the Fed would hike rates. The market gave it a 30% chance. Turns out they did. Now the shoe's on the other foot. The market's saying 100% chance they will. I say they won't. Here's why. The Fed has a dual mandate, as you know, job creation and price stability. Job creation was mission accomplished a long time ago. They're created lots of jobs, unemployment's at a 17-year low. That's not even a consideration because the Fed did what they wanted to do. Disinflation is a real concern. The Fed has a metric, PCE core year over year. It's gone down or flat 9 months in a row from 1.9% to 1.3%, moving away from the Fed's target. There's one more data point before the Fed meeting. PCE, November 30th. If that's 1.3% or lower, which I expect it will be, there's no way the Fed's going to hike rates, and then you'll get this flip in the markets.
With Yellen exiting here, are you expecting more of the same, or can we really expect some changes with Powell coming in here?
It's a great question. I was actually personally expecting Kevin Warsh. So I know Jay Powell from his days back in the Treasury when I was working with the primary dealers. I was counsel to one of the primary dealers. So it's Jay Powell. But that actually makes it easier for me because he's a clone of Yellen. So I have the Fed model under Yellen's chairmanship. So that's why we've been able to get very good forecasts on Fed policy. Jay's going to do the same thing. So I don't have to change. If Kevin had been appointed, I'd have to change the model, but possibly. But now I don't. So it's just going to be more of the same.
Last time you were on, Jim, you made a lot of headlines with your forecast that you don't think $10,000 gold is out of the question. No. People raise a lot of eyebrows, but they don't raise eyebrows with $50,000 Bitcoin calls now. Right. Does that surprise you? Well,
I'll leave Bitcoin to others, but here at the Gold and Silver Show, or Silver and Gold Show, and this morning in my presentation, I went through the $10,000 gold. It's not a made-up number. I don't do it to get headlines or attract attention. It's actually the price that gold would have to be to avoid deflation. If you had a gold standard, or even if you were using gold as a reference in some kind of indirect gold standard, you have to get the price right given the quantity of gold. So the implied non-deflationary price of gold is about $10,000 an ounce conservatively. There are other, if you change M1 to M2 and increase the backing, you get to $40,000 to $50,000 an ounce. I don't have to go there. My intermediate target is $10,000.
But what do you say when people say, look, I know a lot of investors want that $10,000 gold call to come to fruition, but what kind of world would it be like if gold is at $10,000? Is it one we would want to live in?
Well, that's exactly right, Daniel. In other words, if gold goes from, well, today around, just under 1,300 to 10,000, people go, I made a lot of money. No, you didn't, because your money would be worth less. In other words, it would just be a sign of inflation, because this would be the world of, $12 gasoline at the pump and $100 silver and higher commodity prices. But you would preserve wealth. See, the thing is, you might not make a profit in real terms. You will in nominal terms, but everything else is getting wiped out. So I still like gold, even in that world, because it preserves wealth.
What are your thoughts on equities now? I've had a lot of guests come on, some very well-known authors, calling for as much as a 50% correction, and that people are just going to lose everything in equities right now.
Well, you never lose everything, but the idea that there could be a 30, 40, 50% correction, that wouldn't be that unusual. Equities right now, they're in a world of their own. It looks like a bubble to me. We can talk about the Bitcoin bubble, but equities look like a bit of bubble. Using very conservative criteria, the Shiller-Cape ratio, equity valuations to GDP, the lack of volatility, the number of days in a row, the number of months, et cetera. The fact that the expansion is almost 9 years old, the third largest expansion in U.S. history, doesn't mean we have a recession in the market. There are plenty of indicators saying that stocks are at the high end of the range. When markets correct, down 20, 30% is not unusual. Now, it could be faster than that based on some geopolitical catalyst, natural disaster, something like that, but you don't even have to bet on that.
Finally, I know you don't want to talk about this Bitcoin gold debate anymore, but you are on a debate here, exactly on this topic. I know you've said, look, it's not that I don't like Bitcoin, but it's just not for me, right? Well, but my question is, do you even think that Bitcoin can be compared to gold? Is it fair that they should even be debated?
Look, gold is a form of money, Bitcoin is a form of money, so I guess that's an okay debate. You could debate gold versus euros, dollars versus yen. They're all just different forms of money. People say the price of Bitcoin went up. It's not the price of anything. It's a cross rate. It's an exchange rate between dollars and Bitcoin. That's all it is. There are no Bitcoin bonds. You can't invest in Bitcoin. Bitcoin's not an investment. It's a form of money that the dollar's depreciating against Bitcoin, but the dollar's not depreciating against anything else, which tells me Bitcoin's a bubble.
Jim Rickards, always great talking with you. Thank you so much. And thanks for watching. We'll have more for you, so be sure to stay tuned to Kick.